Are you 55 and feeling ready to retire? Well, before you take that big step, there are some key things you need to understand before you do. And not understanding these often overlooked aspects can lead to a lot of financial stress or even sending you back to work. So we're going to go through a case study to show you the options and levers available to you before you make this exciting step. So let's meet Steve and Sally, not real names, but they both came to me feeling like they were ready to retire. They had saved pretty well, over $3 million saved, but something started to stir up in them and they experienced what I call endless delayed gratification, which is for those of you that are diligent savers, investors, you worked extremely hard in your careers, always spent less than you earn, but you've reached a point where these habits that were once fantastic are starting to work against you. But the problem is that when people do start to course correct naturally, and they do feel like they're ready to retire, they're not aware of some of the problems in which you're going to learn in this video. So Steve and Sally, again, both around age 55. If we look at their balance sheet, we can start to paint a picture here of their overall financial picture. And for those of you that are starting to plan for yourself, this is a great first step, getting organized with your accounts, assets, liabilities. What accounts do you have available to you and where do you start pulling from when you do decide to retire and take that big step? So I'm going to use round in general numbers here, but if we break things down by account type, they have cash of around $200,000 here. They inherited a little bit of money recently and held it in cash. They have a brokerage account of around $700,000. That is invested, of course, in individual stocks. They also have around $1.9 million if combine them all in those pre-tax accounts. So basically 401ks, a rollover IRA, and then Steve also has a $90,000 Roth IRA here. And then lastly, they do have their home residence here in California. It has a value of around $1.4 million, which they do still have a $270,000 mortgage remaining. So if we're just looking at the assets they expect to spend from in retirement, that puts them right about $2.9 million in total investment assets in cash. And apart from that, the only other income source will be Social Security. Of course, it's going to be way down the line. And if you're watching this and you are projecting out your Social Security for an early retirement, you typically want to start adjusting your expectation down a little bit from what the statement you read says, because again, it could be a decade or more before your full retirement age. And the Social Security statements that you're looking at are assuming you're going to continue to work until then. So there's going to be a lot of zeros factored into your earnings record before then. And then it's going to be the same thing for both Steve and Sally. Now, of course, it could be a little bit more, but just to be conservative, we're adjusting it a little bit downwards. So we know how much they saved, the account types, what other types of income sources they expect. So let's start to put these 3 key steps together before you retire, because these can make a big difference for you that are watching and you want to retire at 55 versus the traditional retirement. So let's talk about the first step. And what if I told you that you could potentially save thousands of dollars on healthcare costs, even though you have millions of dollars saved? And it all starts with having a clear understanding of your spending and your expenses. So for Steve and Sally, if we start to put things together, they would need to be able to cover all their core living expenses of around $7,000 a month. That is projected basically to be similar over their lifetime. On top of that, we also need to factor in other variable expenses that are ultimately going to go away in retirement. For example, they have a mortgage in which their principal and interest is going to be around $27,000 per year. That will eventually go away in 2036. They also want to travel for the next decade. So we're going to factor in an additional $15,000 per year, as well as another huge factor, which we're going to focus on here, which is going to be health insurance. Now, this first part is very important to understand before you retire at 55 and start implementing any sort of tax strategy that you might hear about online, because most people are talking about retirement tax strategies that apply more to a traditional retirement. And here is why it's different. Oftentimes people hear about great strategies such as Roth conversions or capital gains harvesting, which can be great strategies. I mean, you can realize capital gains at a 0% tax rate, or convert your money from pre-tax to Roth and let your money grow tax-free when your income drops in retirement. But what people often overlook is that when you retire at 55, you are entering in what we call the in-between period, where you've retired early and you're not eligible for Medicare. Now, there are typically a few options, and one that we'll talk about at the end that can save you thousands of dollars in healthcare costs, but this is really important to know. The first option is going to be short-term health insurance. It's basically temporary coverage, and it can be a good option for transitioning in retirement, but it has some pretty limited coverage and might exclude pre-existing conditions. Then there are faith-based sharing programs. These programs work where you essentially become a member and you start to share different healthcare expenses. While this option might offer a lower monthly contribution compared to like a traditional insurance, it's crucial to note that they are not actually insurance plans and might have some sort of limitations as far as coverage for different procedures or any sort of conditions they might have. And then there is COBRA coverage. This option allows you to continue your insurance coverage through work, usually around 18 months. And this option usually have higher costs since your employer is no longer subsidizing a portion of your premiums. And finally, there's the marketplace, otherwise known as Obamacare, the Affordable Care Act. The good news is that these plans are guaranteed issue, meaning you can't be denied any sort of coverage because of any sort of pre-existing condition. However, this is where there is something that people often miss. Now, Steve and Sally, like many of you, they came to me and said, hey, I saw videos on YouTube about doing Roth conversions. We think it's a good idea to start converting some of our pre-tax money to Roth so we can grow and compound tax-free. And we think that sounds like a great idea. Can you help us? And I said, yeah, I mean, Roth conversions can certainly be a great strategy, especially for someone like yourself that has a significant chunk of your net worth in these pre-tax retirement accounts. But are you okay with paying more in health insurance costs? They said, well, what exactly do you mean? So I showed them this tool. Now, this is typically a starting place using this tool. Of course, you need to talk to an actual professional because there's more to this, like prescriptions, of course, your own personal healthcare considerations. But again, to cover their living expenses, let's assume they would need to realize hypothetically around $90,000 in capital gains in their first year. Plus their income would also include some dividends and interest from their accounts as well. Now, here's the thing. If we take money just from their brokerage account, based on how the tax code has preferred tax rates on this type of income, they will be paying $0 in federal taxes, which sounds fantastic, but here's what people often miss. Your health insurance premiums are based not on your taxable income, but what is called your modified adjusted gross income, or MAGI. And this is also going to include things like dividends, capital gains, tax-exempt interest that all needs to be added back in. So let's just say hypothetically we calculate their modified adjusted gross income, and based on their income needs, that would be around $114,000. That means we could still get them a couple $1,000s in tax credit savings here. But if you did decide to say, hey, actually, maybe let's do a Roth conversion, say that moves your MAGI up to $150,000. Even though you may not pay any sort of federal taxes, or maybe you pay very little for that conversion, that means your premiums will nearly double. And you also have to remember that the more your income, the more your potential out-of-pocket maximum might be. So as you can see, you need to be aware of how income and tax planning can affect your health insurance premiums. And by thoroughly understanding your options and leveraging those available tax credits, you can potentially save thousands of dollars on health insurance premiums and ensure your go-go years are financially and medically secure and enjoyable. So now that we have the expenses dialed in and we understand that your expenses are critical and they're going to change when you retire, next we need to understand what type of investments could help your money last through a very long retirement period. We're talking 40 plus years for them. Now, typically when you hear about retirement, many people believe that becoming more conservative is the way to go. But there's a silent killer that can derail your plans, and that's called inflation. And even a modest inflation rate of 3% per year can erode more than half of your purchasing power just over a 25-year retirement period. So let's look at high level on how you might want to think about structuring your investment plan to help your money last and help you continue to buy the things you want to buy throughout retirement. And I'm going to show you why investing for an early retirement is different, because understanding this will give you a clear strategy to make sure your money lasts and grows, and ensuring not only that you can make it happen, but that you can make it happen comfortably. And once you have your expenses in place, you know how much you need to spend. The next step is to make sure you have a buffer of conservative investments set aside for those inevitable bear markets you'll face over a 40-year retirement period. So for Steve and Sally, that means about 30% or so of their retirement nest egg will be viewed essentially as an emergency fund. So when markets fluctuate, we have at least 4 to 5 years worth of income in conservative investments that we can pull from, and we have stability to ride out those tough times without having to worry about it. Now, bear markets typically last around 14 months on average. Now, we have a little bit more of a buffer because what happens if 2008 happens again? That was around 4 years. Again, we want to make sure you have a war chest of cash and bonds ready to go during the inevitable bear market. Now, another key point is that the same investments that got you here may not be the same investments that help you stay retired successfully over the next 40 years. So let's look at how a globally diversified portfolio can offer you multiple return streams, helping you not only beat inflation while also spreading out the risk. Now, here's an example of a diversified portfolio. And of course, these are not any sort of investment recommendations, but they illustrate the concept pretty well. We're looking at global diversification, not just US markets, but international, small cap, emerging markets, things like that. Now, each one of these funds has a specific purpose. We're not just throwing together a hodgepodge of different funds for me to look smart or things to look complex. The purpose is that we have investments that will perform differently at different times, and we can create income from those investments when they are doing well. Now, I read this online a lot. When people think of early retirement, they think, hey, how about we just throw everything in the S&P 500 and we'll have the rest in maybe like treasuries or cash. Now, over the last 14 years, that might have been a fine strategy, but that is hindsight. Hindsight is 2020. The other consideration is that if you retire from 2000 to 2010, the S&P 500 actually had a negative annualized return, and they call that the lost decade. Now, the reason why it's easier to make the argument now for throwing everything in the S&P 500 is because it's something we call recency bias. Now, I'm very patriotic and I believe in the United States, but I also have to reality check myself because I know that there's no guarantee that the S&P 500 will have the same return over the next 14 years that it did in the past. And that's why I still believe in owning things like international, small cap, value investing, emerging markets. For example, emerging markets was one of the best performers during that lost decade when the US underperformed. Because again, we have multiple chunks of the pie to choose to sell from, and we can avoid selling stocks when they're down 20, 30%. We also have cash on the side ready to go, cash and bonds on the side. The idea is to trim off some of the winning investments in the good times and either replenish your conservative investments or take income so that when the inevitable bad times come, you don't have to sell from stocks. But building the right portfolio isn't just about allocation, it's also about location, right? For Steve and Sally, we need to think about tax efficiency. They may have a 70-30 overall, but we don't split this uniformly across each account. I see this with people that even have advisors that get this wrong. Instead, we place more conservative investments in their taxable account because that's where we're going to be drawing income from first. Meanwhile, things like their retirement accounts can focus more on long-term growth, at least until their income changes or life changes. So again, in the first year, they can spend up to $135,000 from their taxable accounts and then none from the pre-tax account. This strategy not only ensures they meet their income needs, but also can help maximize tax efficiency. So by diversifying your investments globally, maintaining a buffer for those inevitable bear markets, and strategically locating your assets in the right accounts, you can ensure you have the greatest chance of retiring early. Now remember, the key is not to set it and forget it when it comes to your portfolio. You want to have a plan that is regularly monitored and you're adjusting your portfolio as tax laws and as your personal circumstance will change over time. But let's talk about the last step, which is how do you actually withdraw from your retirement funds in a way that allows you to not only retire early, but spend comfortably? Because before you retire, you need to understand your options, because some of these traditional retirement withdrawal strategies are not as ideal for someone that wants to retire at 55. And for Steve and Sally, we not only want to factor in that they have a 45-year retirement period, but also they want to leave a legacy. In fact, they want to leave about $1 million adjusted for inflation to their heirs. So we want to factor that into their current spending. But first, let's talk about one of the most common approaches. I call it the static approach, commonly known as the 4% rule. And this is used by a lot of retirees. And this is a rule that has long been considered a safe withdrawal rate after a study first published in the 90s. And it backtested all these different historical market scenarios and founded that over a 30-year retirement period with a portfolio of 50% broad market stock and 50% broad market bond, a 4% withdrawal had one of the highest success rates of never running out of money. And this research has still pretty much held up under the market woes of the last few decades, including the tech crash and the global financial crisis. But here are my issues with using a static 4% withdrawal rate. The problem is that if you follow that static rate, like the 4% rule, there are thousands of different outcomes. And I pull up this chart here from Income Lab. Essentially, it shows a tale of two retirements. Number one is retiring in 1966, one of the most historically bad markets. And if you use this 4% withdrawal rate, in 1966, one of the worst years to retire historically, as you can see by this red downward sloping line, where unfortunately you ran out of money. And number two is the 1986 retirement. As you can see by the green line going up to the moon, and you ended up not spending enough. So in both scenarios, a 4% static withdrawal rate is pretty inefficient. And then depending on when you retired, you either end up with a ton of money, like retiring in 1986 with those markets, and you basically shortchange yourself, or you spend the same amount and exhaust your portfolio if we look at that 1966 retirement period. Now, you might be asking yourself, okay, if a 4% withdrawal rate is inefficient, how much can I safely spend from my portfolio to make sure I never run out of money? And unfortunately, this question is never going to be a slam dunk because there are two variables that are really impossible to determine. The first is future stock market trends, interest rates, inflation, and even tax policies. And the second critical variable is how long are you going to be retired, which is just me being nice and saying, how long will you live? If we knew how to determine either of these variables, let alone both of them, this would be a piece of cake. So because we can't predict the future, our approach with our clients is to, number one, start with your financial plan. What is the current trend of retirement? We want our strategy to take into account all your income, how old you are, your expenses, your total net worth, your estate goals, and also your legacy goals. And from there, we take it one step further and say, what does the research say as far as my spending and how that would work even during the worst market periods? So this is where taking a dynamic approach can be more optimal and allow you to take more income as long as you're willing to be flexible, which is just a fancy way of me saying, instead of sticking your head in the sand and just taking 4%, when times are good, we'll take a little bit more each month. We'll give ourselves a little bit of a bonus. But when, not if, times are bad, we're going to have to cut back a little bit until things get better. The difference between these approaches and the 4% rule is that instead of viewing retirement as pass or fail, we view retirement as what is the probability of adjustment. Failing is just not an option for us, and for people that are okay with being flexible, this approach seems to make a lot of sense. So here's how it works in practice. Again, this is Steve and Sally's plan. Again, their projected balance is going to be around $2.7 million. They want to spend around $11,000 per month. So this is what I mean by being dynamic. If I click on this right here, this is going to show how this works in practice. This is saying essentially looking at their projected balance at retirement of $2.7 million. If the market were to drop by 49%, we'd want to start reducing income by around 3% or $400 per month. On the other side, we're saying that if the market were to rise 28%, then they could start taking additional income. Now, the reason why there's such a big difference here is because we're trying to be really conservative in their spending, where you're going to have a retirement period for over 45 years for them. If we look at their longevity settings here, yeah, we're projecting that they're going to live longer than 80% of people their age, around 46.6 years. Now, of course, you can adjust that depending on if you have longevity in your family or not, but this is a key factor when it comes to dynamic spending, so you can stay on track. So when you reach those inevitable bear markets, you know exactly at what dollar amount you need to start adjusting your spending. And also you give yourself the potential for bonuses when the market does do well. Again, there's no silver bullet for retirement distributions, but we want to find a balance between taking on risk, but also being able to maximize your income. But a simple rule of thumb will not factor in all your other income sources and connect it with your investments, your tax plan, as well as your estate plan, which is why people are really surprised when they've learned about this sort of strategy and they do have enough saved and maybe the 4% was shortchanging them. But finding the courage to stop chasing that portfolio number and continue the endless delayed gratification can be mitigated by understanding this sort of strategy. So if we put it all together, now that we know how to factor in health coverage and your expenses in retirement, how we need to invest differently once you retire early, and we know that being dynamic and flexible with your spending will give you the highest probability of enjoying your retirement. If we put that all together, this can help give you a smoother ride in the best possible early retirement. Because at the end of the day, having an effective early retirement strategy comes down to what are your income needs today, what might your income needs be in the future, and how do we set up a strategic plan to help you get there. But we didn't spend a ton of time on this sort of withdrawal strategy. I actually made a video that you should definitely watch, and I compare all your different options for an early retirement when it comes to withdrawing money. You can watch that by clicking right here. Again, this is Matt. I'm a certified financial planner and advisor with Wonder Advisors. If you'd like to talk to me or someone on my team about your financial plan, you can click the link in the description, and we would love to talk with you.